Okay, yes. If we talk about U.S. Bureau of Labor Statistics announced that inflation was cooler than expected in October. The data also show the annual CPI number below 8% for the first time in 8 months. With this report, will the Federal Reserve or the Fed slow the pace of interest rate hikes in upcoming meetings?
Yes, I think so. What we saw was headline inflation peaked in July at 9.1%. This month came in at 7.7%, which was much lower than expectations of 8% and lower than the previous month of 8.2%. And the month-on-month headline inflation number came in at only 0.4%, which was lower than estimates of 0.6%. So things are certainly moving in the right direction. We saw some relief in used car prices down 2.4%. Apparel was down 0.7%, and medical services was down 0.6%, as well as piped utilities was down 0.4%. So we're seeing relief across the board. What this has done in terms of interest rate hike expectations and why you saw such a big rally in the United States, it's actually lowered the expectations dramatically. If you look at Fed funds futures, which measures the expectations for the December meeting, just one day ago, they expected only a 56% probability of a 50 basis point hike in December. That probability has now jumped to 85.4% probability for the month of December. That will only go 50 basis points as opposed to 75 basis points, which many people thought would be the case after the Fed's most recent hawkish talk. So the data is now lowering expectations. You also saw a situation where the terminal rate from the Fed dot plot at the last meeting was 4.6%. Between that meeting and 2 days ago, people were expecting that terminal rate to go up to 5%. And now those expectations have backed down closer to 4.6% from the dot plot. So when you see the inflation numbers coming down, it means the Fed can start to go more slowly, and the market likes that quite a bit, Bram.
Okay, and if we look what's the market expectation of the Fed's rate hike at the end of this year and in early 2023, after the inflation report for October, Wall Street moved higher, or investors were optimistic about the good news?
Yeah, I think what you're going to see is, 75 basis point rate hikes are now a thing of the past. I don't think we're going to see any more 75 basis point emergency rate hikes. More likely, if you look at Fed funds futures, you're going to see 50 basis points in December, and then either a pause or a move down to 25 basis points in the following meeting, and then that should be the end of it. So the market's now starting to price in the end of Fed tightening. Whether that ends in December or at the following meeting is unknown, but that will just depend on the data coming in. Before the December 14th meeting, which they're now expected to do 50 basis points, we're going to get two important data points. We are going to get the employment report, the non-farms payroll, on the first Friday of December. So that will be very, very important. And we're going to get another inflation report the day before the next Fed meeting. So that's going to impact how high they go. And if we get another beat like we saw yesterday, it's not outside of the possibility that maybe they only go 25 basis points. That's a lower probability, but at least for now, the emergency hikes of 75 basis points are likely off the table, and they'll be going only 50 and possibly 25 if those data points support it in December.
Okay, yes. Fight with rising prices was far from over. CNBC reported that prices in US started rising at an unusually fast pace starting in early 2021, following years of low inflation as the US economy reopened, and a supply-demand imbalance fueled inflation that was initially limited to many items. Has there been a problem in the industrial sector that caused this supply-demand imbalance?
Yeah, we had basically two problems that caused the inflation, Bram. First and foremost was COVID-driven supply-based inflation. So with the shutdowns in Asia, with the shipping bottlenecks, with all the factors that were caused by COVID, you had supply-driven inflation. Then you had the war with Russia-Ukraine that created some energy inflation that compounded things. Then you got some shortage of labor because of all the stimulus in the United States. More people wanted to stay home than go to work. So all of these things came together. But the number one thing that no one's talking about that was the biggest impact on inflation was profligate spending. Certainly in 2020, the need for a couple $1 trillion for the CARES Act was essential to keep people going during the lockdown. But it was the spending, the subsequent spending bills, when we already saw signs of inflation, that they continued to ramp up spending aggressively. $1.7 billion, $1.7 trillion of spending with the Build Back Better program. $750 billion with the Inflation Reduction Act. There's a lot of spending embedded. And most recently, the cancellation of student debt, which was estimated to be about $300 billion. That was struck down in the courts yesterday, so we'll see if that goes through. But the key is, with the election, and I know we're going to talk a little bit about that, as this spending is slowed down and stops, it gives the Fed the ability to fight inflation more effectively. So raising rates while Congress was spending trillions and trillions of dollars is like trying to fight a forest fire with thousands of trees on fire with one single fire extinguisher. And they were ineffective in doing that. And that's why they were panicked with all of these 4 emergency rate hikes in a row. And I think now that spending is going to slow, you're going to see the effects of that tightening kick in very, very quickly. And the Fed may be able to back off sooner rather than later. And markets, as a discounting mechanism, are starting to sniff that out. And we saw the first taste of that yesterday.